This is the Build Wealth Canada podcast, episode number 48.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell and welcome to the Build Wealth Canada show. Canadian investors are having a pretty eventful time in the markets right now as the legalization of marijuana is happening today as I record this episode. And let's not forget the hit that the markets took last week. So for a long time now, we've seen very little volatility in the markets, and it's been a relatively smooth and enjoyable ride. Well, finally, last week, we finally got to experience how markets can behave in the negative sense. And I think how you felt during this period is a good sample of how much you can stomach volatility and stay invested when you have some media making it look like the sky is falling. Now, we can and will experience drops even worse than that in the future, realistically, but I think it's a good self-discovery event where you learn if, for example, that 100% stock, 0% bond allocation portfolio is something that you really can have and still sleep well at night. So because of the marijuana legalization and the recent dips in the markets, I thought it would be great to have another investing tips episode like we did last month, where I speak to 5i Research CEO Ryan Modesto about what him and his research team are seeing in the markets with the recent decline, as well as address the subject of marijuana stocks and investing in that industry. Now, typically, I'm not going to have these types of episodes back to back. You can definitely expect the types of episodes that I normally have once a month, plus this type of investing tips episode once a month. But right now, because of what has been happening in the investing world, I wanted to get this out to you ASAP. Of course, don't miss future episodes, giveaways, and free in-depth guides by signing up for free to the Build Wealth Canada newsletter over at buildwealthcanada.ca. There, you'll receive some exclusive educational content that's only available to Build Wealth Canada newsletter subscribers. There's never any spam. It's totally free, and it's also the best way to ask questions that you want answered on future episodes of this show, as well as suggest any guests that you'd like to have come on the show too. So that link again is buildwealthcanada.ca. All right, now before we start the interview with today's guest, 5i CEO Ryan Modesto is also offering a 1-year free digital subscription to Canadian Money Saver magazine for Build Wealth Canada listeners. And Canadian Money Saver is Canada's largest personal finance magazine. And you'll basically get this for free when you sign up for free 30-day access to 5i Research. So there you'll receive over 70 company reports, which is perfect if you like to sometimes invest in individual stocks, 3 model portfolios, and answers to over 75,000 investing questions, along with the ability to ask your own questions directly to Ryan and his team of analysts. Now, Ryan and his team at 5i don't sell any investments, and they don't get any commission or bonuses from suggesting stocks and ETFs. So I've been a long-time partner with them, as they are one of the very few companies in Canada that are actually truly unbiased and conflict-free when it comes to their research and suggestions on stocks and ETFs. All right, so you can get the free 30-day access to all the research and resources over at buildwealthcanada.ca/research. And as a thank you for trying them out, you'll receive a free 1-year digital subscription to Canadian Money Saver magazine, Canada's largest personal finance magazine. So I encourage you to check 5i out. It's a great place to get some truly unbiased insights on your investments, whether it's stocks or ETFs. You'll learn an absolute ton. And now let's get into the show. Hello and welcome to Investing Tips. I'm Cornell Schreiber. I'm here with 5i Research CEO Ryan Modesto. Ryan, welcome to the show.
Thanks for having me.
Ryan, let's start off with a market update. The markets have clearly been hit pretty hard lately. What's the 5i Research team seeing, and should we be worried?
Yeah, so we're seeing a bit of a sell-off in markets right now. I think as we tape this today, markets are down maybe roughly 0.5% in both the US and Canada. Things are really volatile right now, changing very quickly. On a year-to-date basis, when you're looking at the US, US is still up. People have been worrying about how the markets are doing, but US is still up 3.5% year-to-date. But month-to-date, it is down 5%. So it's been kind of a fast and furious sell-off. But the nice point, I guess, is just that markets in the US are still positive on the year. By the time we're finished recording this could change, but that's part of investing, I guess. In Canada, it's a bit of a sadder story, I guess you could say, where year-to-date markets are down about 5%. And a lot of that sell-off has happened just in the last month, where they're down, like month-to-date markets are down 4% on the TSX. So what looks like the main issue of what's going on right now is that the Federal Reserve in the U.S. is raising interest rates. And as interest rates go higher, markets get concerned that it's going to constrain growth. So higher rates on debt means that you have to pay more on that debt, which means you're less likely to take a loan to invest in a growth project, to buy a house, whatever that may be. And also a higher debt level means that your interest payments increase, and maybe your discretionary spending as a consumer, instead of going out for dinner this week, you'll now have to save that money and put that towards your potentially higher interest rate. So a lot of the concern is the rising interest rates constraining growth. And obviously, if growth expectations go down, stocks will go down with it. And then there's some other kind of more nuanced issues where when you're valuing a stock, you use a discount rate, and higher interest rates mean that value of the stock goes down. But we think the big thing is just it's an issue of higher rates right now, and then you kind of have this other issue going on that's sort of related and sort of its own issue surrounding global growth. So kind of issues like the trade war and the emerging market route right now is making market participants start to kind of ratchet down their global growth expectations. And again, if companies are doing less trading and less investing across countries, then you're going to have some market impact as well. So it really seems like it's coming down on interest rates. But the important thing to remember is that the interest rates are going up for a good reason right now, right? They're going up because the economy is strong, because unemployment is really low. There hasn't been a whole lot of wage growth, but that's starting to maybe sneak into the picture a bit as well. So, it's not these rates are more of the rate increase is more of a proactive move by central banks to help to make sure that growth doesn't overheat too much too quickly, right? They're not doing it in a defensive, reactive type of situation. So there is that kind of give and take, and when you're looking at it, it doesn't look like some sort of recessionary issue where markets are selling off because something really bad is happening. Actually, when you look at the economic side of things actually look pretty good. And even if you go to the company level, earnings have been pretty good as well. You're not every quarter is going to be a massive beat on expectations across the board. You're going to have some softness here and there, especially when you're comparing it to good growth in prior quarters and prior years. But companies are still growing earnings overall. So we still think there's a lot of reason to be optimistic with the markets. And at the end of the day, these sell-offs are not nice, and we've been spoiled over the last couple of years with low volatility, but it is a part of the markets. And a 5% pullback is not overly rare, and neither is a 10% pullback should be kind of the base expectation when investing in equities. So no one wants it. You always want markets to go up regardless, but that's just not the way it works. And you need to take on that kind of volatility risk. That's why over the long term, markets reward an investor, right? Because you're taking that risk of losing money to make money, essentially.
Now at 5i, you guys have the research team is actually accessible. So any investors that are part of 5i can actually go in there, they can ask questions. I'm assuming you guys, you and the research team have been getting a lot of questions about what's been happening in the markets and the declines, that kind of a thing. Are there any sort of really big concerns that jump out that a lot of people are asking that you want to maybe address? Anything like that?
We're pretty impressed with the response of our members, actually, where it's less been a, should I be worried about this pullback, or should I go and sell? And it's more of where should I be looking to invest more money kind of thing. So it seems like a lot of people are kind of viewing it as more of an opportunity, a chance to pick up some interesting investments that you've been watching that are now a bit cheaper than they were before. And we think, as it stands now, we think that's the right approach. And just kind of, looking for those, a lot of times that quality, often a dividend payer that, interest rates aren't really going to change much about their business, but they've sold off because of it, and now you can kind of get a nice little entry price and a nice yield on a stock that maybe you wouldn't have gotten otherwise. So so overall, we've actually been impressed with the response, I guess from our membership.
That's great. Now let's change gears a bit and talk about the legalization of marijuana, the cannabis industry in general. I mean, the legalization of marijuana is coming to Canada pretty soon. The industry is expecting to experience rapid growth. And so for investors interested in this industry, what should they be looking out for?
Yeah, so this is a tough space overall right now. We think you need to approach it with two kind of hats, right? So the one hat is kind of the fundamental one, where you're looking at the revenues, the balance sheets, the total market potential, all of that kind of stuff. And when you're looking at the space and the valuations too, and when you're looking at the space from the fundamental point of view, it's pretty hard to get to a point where you can look at a lot of these companies and say, with high probability, I think at this valuation, this investment makes sense, kind of thing, right? A lot of these companies are trading over, I can't remember what the number is, but I think over like 15 times sales right now, and definitely over 10 times sales regardless, right? And that's, you're talking top line revenues, not even including what your margins are, because you don't really know what margins are going to be on these companies yet. You're not including competition, potential regulation, all that kind of stuff. So fundamentally overall, we think to get to a point where you can be kind of confident from putting numbers to the investment, you have to kind of assume things like global domination of the current companies, and not just in the flower itself, but in the derivative products as well. So that's kind of the fundamental side where you could still make money on it down the road, but it's hard to justify when you put any numbers to it, and that's just because there aren't much numbers out there yet. It's a new industry. Nobody really knows what it's going to look like down the road, and there's risks and rewards that come with that kind of assumption of risk. But on the speculative side, it's a bit of a different mindset, right? So any given day, these stocks can move up or down 10%. So there's potential to make or lose money in that side, but you have to embrace that and understand what you're getting into, right? You have to understand that a single news release from company X may make company Y jump or fall by some ridiculous percentage point, and that may or may not be even reasonable, kind of thing, right? So that's just kind of the understanding of it you have to have. And if you're more of kind of taking maybe a longer term approach, you have to just be comfortable with the idea that you could buy it today, and within a month you might have to sit on a 25% drawdown for another year or something like that. So it becomes a bit of a long-term story, I guess. But so overall, it's kind of two hats we think you need to approach with it. We think if you really want to get involved, maybe the area to look at is kind of the complementary businesses, right? So there's cannabis retailers out there. There's the liquor companies that are trying to get involved in the space, and even Coca-Cola has talked about entering the kind of the cannabis infused drinks, and so there's those kind of ways that you can maybe get some optionality on the space, and those companies are ones that are trading at more reasonable valuations compared to maybe the actual producers.
Gotcha. And then I sometimes hear investors say things like, well, I think industry X is going to grow in the future, so I'm going to invest in it. So for example, the cannabis industry now, or AI or robotics, or, et cetera, industries like that people just think have a lot of potential. It seems obvious that they're going to grow. They see all this money being pumped into it. They see it in the news all the time. What is the error in using that reasoning as your sole decision to invest in a particular industry?
Yeah, it can be kind of a dangerous strategy to play sometimes, because a lot of time these themes can get ahead of themselves, and by the time you're hearing about it, you may be kind of late to the party, right? So so blockchain, 3D printing, and even the initial .com boom are all great examples of this, where there's that sort of it is a new industry. You don't really know how things are going to turn out. But you kind of jump in on the hype. So It's one of those cases where if you're early, it can work out really well. But I mean, nobody really wants to be the one buying at the top when it drops, 20% in a day or whatever the number is. So we think if you want to get exposure, you kind of have to check on three things. So you want to think if you're late to the party. So this is obviously, the $1 million question regardless. So, but if you're thinking about it and, this topic or this theme is all over the news, you're hearing about it in coffee shops, your Uber driver's telling you about it, you're probably later in the game. And you might just want to wait till things settle down and some of that kind of that frothiness or hype subsides. The other thing is, can you handle the volatility regardless? A lot of people like to see the big spike in the share price or in the chart or whatever, but can you also handle it on the downside as well, right? And there's a difference between saying you can and then experiencing and actually being able to withstand that drawdown. So you really need to kind of do a personal check to make sure that you are an individual that can handle the volatility psychologically and also from a portfolio financial point of view. Can you handle whatever portion of your portfolio to fall by that amount, right? And the next thing is what's your time frame? Because new industries, they're not built in months, they're built in years, right? So even if you get kind of this initial run up in a share price, maybe it's too early and it comes back down. Now you're kind of thinking you're holding at a loss, and you just have to start thinking years into the future because it takes time to build a market share and do the marketing, do the branding, build a business. Essentially, this doesn't happen in the short term, and a lot of things change as there's more certainty in an industry and the market's more proven and bigger companies and more money starts to flow into it. And that doesn't necessarily mean that the current incumbents are going to be the one that benefited. Sometimes it can be the case, but other times there'll be new players that maybe have a better way to do it, or there's just increased competition that crowds out the highly valued company that you were looking at before. So we think there's kind of those different things you have to check. And then the final thing is just do a gut check on yourself. Like, why are you looking at getting into this sector? Is it because your neighbor did well in it and you're getting some FOMO, so you think you want to jump in now? Or is it something where you've done some research, you see the potential, and you understand kind of the risks and rewards involved? The one nice thing with the mention of ETFs is that you can actually, it's sort of easier for an investor, maybe a good and a bad thing, but it's easier for an investor to get exposure to these kind of themes in more of a diversified manner. There's lithium ETFs out there, there's AI ETFs out there, and I'm not saying they're going to do good or bad kind of thing, but in the early stages of the industry, you're usually better off to at least approach it in a diversified manner instead of just trying to claim your stake in a single company, just because there's so much uncertainty in how this industry is going to develop, right? So, and generally, that just gives you that broad exposure to benefit from the rising tide of the industry as a whole. So, in general, though, while there's a lot of potential in these new industries, we at 5i, we far prefer kind of proven businesses, proven industries, some sort of revenue track record, and even kind of an operational history, a successful management team, all that kind of thing. Because there's, you don't have to speculate on unproven companies or unproven industries to do well in the markets. There's plenty of investment opportunities of quality companies with good track records of cash flows, earnings, revenues, all of that kind of thing.
Mm-hmm. And when you mentioned about one option being just choosing an ETF that tracks that industry as opposed to picking and choosing individual companies, I mean, I assume if we take that approach, then really what you're pretty much betting on is that industry in Canada, for example, overvalued or undervalued and is going to keep growing? Or is that what all those companies in that ETF are valued at? Is that already kind of, is all of that factored into the price already? And so is that pretty much kind of what you're betting on in that point, versus if you're doing individual companies, then not only are you betting on the industry, but you're also betting on the individual companies. So there might be some more potential for growth, but also probably more volatility, I would assume.
Yeah, well, the companies make up the industry, right? So if
Right.
you own the industry, you're owning kind of the valuations of the underlying companies as well. It's more so just kind of saying that, I don't necessarily know how this industry is going to develop over the next 1, 5, 10 years, but I want some exposure in my portfolio to what I think is going to be a disruptive or a game-changing industry, whatever you want to call it. And so if you own the ETF itself, you don't necessarily have to worry about a single stock in a 20 or a 50 stock ETF doing good or bad, because you can be more confident that if the industry does well, whatever the number is, even if it's 50%, 90% of the industry will do well with it as well. So that's kind of the play, more of a portfolio approach, I guess, opposed to a single, like a stock picking approach.
Mm-hmm. Yeah, so a bit of an alternative to maybe take a little bit of the pressure off and not feel like you have to choose just the right company in order to kind of get those gains that you're hoping for, that kind of thing.
Yeah, for sure.
Yeah. Now, you guys did a lot of work on a cannabis report over at 5i as well, where you looked at some of these main players in the industry. Can you talk a little bit about that report? And we'll make sure we make it available in the in all the notes, and that we link to it and all of that.
Yeah. So we did a kind of a special report on the cannabis industry. And it's sort of funny how quickly the industry's changed, right? Because we need to kind of go through it already and update a few things. Just even the as we were writing it, Ontario was gonna do kind of like the LCBO type of model for selling cannabis, and now that changed to starting out just online sales, and then they're going to open it up to private companies as well, which kind of changes the game a bit, right? So it's which is just a great example, and that happened over like a 2-month period, I think, from when we wrote it. So it just shows how quickly things do change in the industry. But yeah, so we can definitely update that and provide it. We look at sort of just an overview of what the industry looks like, the total market potential, all that kind of thing. And then we go into some of the larger producers that are involved, and then also some kind of like, as we were talking about, some complementary type of companies that they're not necessarily selling cannabis directly, but they are involved in the business in some way where there may be a complementary kind of exposure. So,
gotcha. No, that sounds good. Yeah, I remember looking through it, and it was really interesting, even just to learn about the industry itself and what are all the different pieces of it, right? Because it's not just the producers. There's a lot of kind of other businesses that kind of support that and all that. So it was it's interesting just to kind of, as a piece of your due diligence, basically, when you're deciding whether to buy a particular company or maybe the ETF or anything like that. No, that's great, Ryan. So let's maybe get into one of the listener questions that we had. So this one was from Hillary, and she was asking, what is the difference between a common and preferred stocks, and what should an investor consider when choosing between the two, and should a company offer both?
Yes. Okay. So this is a topic we see that often gets kind of misunderstood by a lot of investors. So you essentially have a risk hierarchy in the capital structure for a company. Excuse me. So it goes bonds, preferred shares, stocks, essentially, where bonds are the safest investment, preferred shares are more risky, and stocks are the most risky. In a bankruptcy scenario, bondholders get paid first, then preferred shareholders, and then equity holders. And typically, even if the bondholders get paid, then that's rarity probably, where, I mean, even if you're a preferred shareholder, we wouldn't really count on getting your money back in a bankruptcy scenario. Similarly, if dividends are cut, the dividends are cut on the common shares first, and then they're cut on the preferred shares. And then finally, you have an issue where you can't pay the fixed income distributions. So we have a blog on our website on this that's we call it Worst of Both Worlds. So it kind of beat up on the preferred share space a bit, but it gives a good overview of what is involved in preferred shares and the differences from equity and fixed income and all that kind of thing. But overall, they're more risky than bonds, but less risky than equity. One common equity or stocks. One common misconception we often see is that a lot of investors think that a preferred share, matures, and that you're going to be made whole upon some sort of date, and the company is going to buy those preferred shares back. This isn't the case. They're not like bonds, where a bond has a maturity date, and on that date, you get your principal back. A preferred share could trade below whatever price you bought it at indefinitely. They could also pay those distributions indefinitely as well, or the dividends indefinitely as well. So there's a bit of give and take there. But yeah, they are not like bonds, and we think they often get viewed as bonds, which is, there's some parallels you can make, but they are, again, more risky. And they often get compared to equity too, but they don't share in the same growth that you get by owning the common shares. So that's just one thing to kind of keep in mind and be careful of. We think when you're choosing, so if a company offers both and you're choosing between the two, it's more of a personal, I'm not trying to be vague here, but it's more of a personal decision, and not really, is one better than the other. So if you're more of a, an income investor looking for something that offers more stability and more reliable cash flows, then maybe you'd want to go with a preferred share over the stock. But if you're someone who's thinking more total return, and you want the capital gains and maybe a bit of a dividend as well, if the company pays a dividend, then you probably want to go with the equity. Of course, this comes with a bit more volatility than you're going to see in the preferred shares, but preferred shares aren't immune to volatility as well. In the maybe it was like 2 or 3 years ago that they saw a pretty material drop, and they since kind of recovered from that. So no right or wrong answer on which one to choose. As our bias at 5i, we typically always prefer owning the equity, especially if they pay a dividend anyways, just because then you get that stable dividend stream, but you also get the growth potential in the shares, which can often eclipse any dividend you'd get over the years, kind of thing. But of course, it comes down to that personal decision of, why do you want preferred shares in your portfolio, and does that make sense for your given situation or your certain allocation you're looking for. So with that said, preferred shares do make sense to some degree in a portfolio. What that amount is a personal decision, but it makes sense as a supplement to kind of get a higher income stream in a portfolio. But yeah, I wouldn't really view it as a looking at a company and am I going to go preferred or equity. It's more of a, what do I need? What's the allocation I need in my portfolio, if that makes any sense. But
okay. No, that's great, Ryan. Thank you. So that's all for the questions we had this time. If anybody listening or watching, if you have any questions, you can definitely send them over. We'll have the links down below where you can submit it. With 5i too, if you do a free trial, you'll also get 1 free question credit. So you can actually go in there too, and you can ask the 5i research team your investing question. So if you have a specific question about a specific stock, let's say, then that's the best way to do that. If you have more of kind of a more general question that has good broad appeal, then definitely let us know, and we'll try to include it on the next episode as well. All right. So thanks for coming on, Ryan. I look forward to next month, another market update. Hopefully the markets treat us a bit better next. For sure. Yeah. Fingers crossed. But but it's nice that you guys, you and the team are monitoring it constantly, and then just kind of seeing sort of what's happening gives us a bit more clarity. And I find you guys help keep some of those emotional reactions at bay, just by educating investors about what's happening, and just helping them come to terms that if you are in equities, it is going to be volatile from time to time. You are going to have those drops from time to time, and this is just part of it. So thanks again for coming on. Great that you're here, and hopefully look forward to seeing you next month.
Sounds good. Thanks for having me.
All right, thanks, Ryan. Bye. All right, I hope you enjoyed the episode. We have some really exciting episodes coming up. And if you haven't already, let me know if you like these types of episodes too, in addition to the ones that I normally publish. Now, definitely submit your questions to potentially have them featured on the show by signing up to the buildwealthcanada.ca newsletter and basically hitting reply to any of the emails you receive from me. And then I basically read all of them, and I will do my best to have your question answered on the show. And lastly, don't forget to get your free Canadian Money Saver magazine subscription by checking out the research and answers over at 5i Research by going to buildwealthcanada.ca/research. research. Of course, if you like the show, please go to iTunes, leave the show a rating and review. I'd really appreciate that as well. And, feel free to give me your feedback as well in terms of what you'd like to have on future episodes of the show, any guests you'd like to have, any questions you'd like answered. And I will be more than happy to try to get all of that in future episodes of the show. All right. So that's all for now. Thanks for listening and supporting the show, and see you next time.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.